All right, welcome to this explainer. Today we are taking a really structured look at the actual mechanics behind financial markets. You know, even if you're someone who follows the markets every single day, it is incredibly valuable to unpack the architecture step by step just to see how the engine truly runs underneath it all.
Okay, let's dive into this. Here is our roadmap for today so you know exactly what mountains we'll be climbing. We've got 1. Foundations of financial markets. 2. Raising capital, the IPO. 3. The secondary market engine. 4. Funds, ETFs, and derivatives. And lastly, 5. Smart investing and scam prevention.
Starting off at base camp with Section 1, Foundations of Financial Markets. Let's build the basics.
So as this brilliantly illustrates, the whole financial ecosystem basically splits right down the middle based on the duration of capital. On one side, you have short-term money markets. This handles borrowing and lending up to a year, using instruments like treasury bills or commercial papers. On the flip side, we have the long-term capital markets. This is where businesses go for serious heavy-duty funding. And naturally, because it's a much longer horizon, it definitely carries a higher risk profile compared to the short-term side.
Now, zooming in on those long-term markets, the capital structure splits again, this time between debt and equity. On the debt side, instruments like bonds essentially represent a contract. You're looking at lower risk, sure, but you're locked into lower returns via fixed coupons, and they return your principal. Equity, on the other hand, that means buying a piece of ownership. It strips away guaranteed returns entirely. You're taking on maximum risk, but in exchange, you get a share in the profits and potential capital appreciation.
Moving right along the trail to Section 2, Raising Capital, the IPO. Time to enter the primary market.
You know, when a company launches an IPO to raise fresh capital from the public for the first time, they generally decide the share price in one of two ways. A fixed price issue is exactly what it sounds like. They just set a price. But book building? Now that is a really fascinating mechanism for price discovery. The company sets a floor price, or a price band, and investors bid within that band over a few days. The price point that receives the maximum bids becomes the final offer price. It essentially lets the market itself decide what the shares are truly worth.
But wait, what happens right after the IPO actually launches? Sometimes the market gets a bit crazy. Enter the green shoe option. This is a very clever stabilization mechanism. If the newly listed stock price drops below the issue price, a company-appointed agent actually buys shares from the market to prop it up. But if the stock price surges wildly, underwriters can actually buy extra stock from the company, up to 15%, and sell it to the public to cool things down. It's basically a shock absorber that keeps early trading smooth during those critical first 30 days.
All right, Section 3, the secondary market engine. This is where the actual trading happens and provides liquidity.
Now, obviously, in the modern market, we aren't swapping physical pieces of paper anymore, right? We use depositories like NSDL and CDSL. Think of them as banks, but instead of cash, they hold your securities electronically. This magic of dematerialization completely eliminates the risk of bad delivery. It cuts out massive amounts of paperwork and allows for the immediate, seamless transfer of securities.
Okay, so how does this actually play out when you buy something? When you hit buy, it triggers a 3-step cycle backed by the clearinghouse, which basically acts as the guarantor for the trade. First up is trading. That's simply the placement of your order. Second is clearing. This is the behind-the-scenes math where they determine exactly what funds the buyer owes and what securities the seller owes. And finally, settlement, the actual final exchange where funds go to the seller and the electronic securities drop safely into your demat account.
Section 4. Funds, ETFs, and derivatives. Let's expand your toolkit with some advanced gear.
We all know about standard mutual funds pooling money for diversification, right? But recently, a new player has become incredibly popular among both institutional and retail investors. So what exactly is an ETF? Have you ever wondered how it differs from a traditional mutual fund?
And this brilliantly illustrates the answer. An ETF, or exchange-traded fund, is a fascinating hybrid. Like a mutual fund, it is a pooled investment offering great diversification. But unlike a traditional mutual fund, an ETF trades directly on an exchange just like an individual stock. You can buy and sell units intraday as prices fluctuate with demand and supply. It kind of gives you the best of both worlds.
Now, stepping into a highly leveraged arena, we have derivatives. These are financial contracts that derive their value from an underlying asset, like a stock or an index. Options are a key type of derivative here. When you buy an option, you're paying a premium for a right, but critically, not an obligation. A call option gives you the right to buy an asset at a stated future date and price. You'd buy this if you expect the market to go up.
A put option gives you the right to sell an asset at a stated future date and price. You'd use this if you expect the market to drop. They are highly leveraged tools, and honestly, they require serious knowledge to use safely.
Finally, Section 5. Smart Investing and Scam Prevention. Time to equip you with the street smarts to protect your wealth.
Picture this. You check your phone one day and see a message sounding exactly like this. Multi-bagger stocks, which can shoot up at any time. Buy them now. Welcome to my profit-making channel. Subscribe for more such news. I mean, sounds exciting, right? It feels like you've just been handed the golden ticket.
Okay, let's be real. As tempting as that sounds, it is classic bait for illegal pump-and-dump schemes. Fraudsters will artificially inflate a tiny, illiquid stock they already own, wait for the hype to push the price up, and then dump their shares, leaving you holding the bag with massive losses. Also, keep an eye out for anyone promising guaranteed 2% monthly returns. Let me be clear. Guaranteed returns in the stock market are completely illegal. Any unsolicited tip, or anyone asking for your login credentials to trade on your behalf, is a massive, flashing red flag. Do not ignore it.
So here are your golden rules for survival. A smart investor absolutely does not share their DMAT login or password with anybody. Doing so is literally like handing a stranger a signed blank check or leaving the keys right in the front door of your house. Furthermore, do not keep idle funds or transfer idle securities to your stockbroker just for the sake of it. Brokers are not bankers. After every settlement, just make it a habit to check your bank account and your DMAT statement. Ensure your funds and shares have arrived safely within one working day.
Financial markets are incredible engines for wealth creation for sure, but they demand respect and constant vigilance, no matter how long you've been trading. So I'll leave you with this provocative thought. Will you let the noise and illusion of easy money distract you, or will you stick to the disciplined, informed strategies that actually build wealth? The choice is entirely in your hands. Thank you for joining me on this explainer. Keep learning and stay smart out there.